Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel for our final live, well, I guess not true, our second to last piece of live content for y'all today for building a stock portfolio. I am your host, Kevin Horner. The reason I said that this afternoon, of course, we do have our virtual workshop options, and specifically with my friends Ray Kimbrell and Scott Durfee as well. So make sure if you're interested in that discussion, you're checking out our calendar after this one. That'll get going a little later this afternoon. But today we have seen some pretty significant moves in the market over the last week since we last convened. And as a result, of course, that means our example portfolio has seen some action. So we're going to review a number of the example trades we'd had on that have now been closed due to moving to the sidelines on our exit strategies. We still have a few existing example trades we're working with there, and we're going to place some new example trades in the account today to get that money that we've generated, that cash balance we've built, to get it back to work. So before we do that, though, take a minute, say hey to my buddy James Boyd here in the chat. He'll get to comments and questions I'm unable to, but I'm going to keep a close eye on things nonetheless. So feel free to post in there for the duration of the show. We're going to go about 45 minutes in total. If you're not already doing so, I do know you're missing out if you're not following James Boyd and me on X. So James Boyd CS, Kevin Horner CS, a great spot to find us when we're not hosting classes for you here. JB will frequently post for you individual pieces of news and data and relative to individual stocks. I'm going to drop in there as many charts as I possibly can. Great spot to find us, though. Follow us there, James Boyd CS, Kevin Horner CS. And with that, let us jump to the disclosures so that we can get to the market review to kick things off. So first of all, remember, everything we discuss should be considered informational and educational only today. We do not make recommendations nor endorsements for any specific approach to trading here. What we're offering up is educational and informational exclusively, so please bear that in mind. Now, we will use technical analysis as we discuss our process a little bit in terms of adding new example trades to our portfolio, moving on from those example trades. We will use technical analysis in that process, but do not consider it the only means of your research. We want you to be aware of it, maybe utilizing it even, but don't rely on it alone for your insights as to whether you are a buyer or seller at any given moment. Please use a multitude of data points. All right, in this class, we generally don't discuss or utilize options, but just know options carry a higher level of risk. They are not appropriate for all of us as traders and investors. And in order to trade options here at Schwab, we do ask you to approve each individual account in which you would like to trade options. You can have different approval authorities from one account to the next. Okay, with that, everybody, let us take a look at the S&P 500, see how we finished the day. And I'm sure the main takeaway here initially is, my goodness, what a tail we had down here today, right? What did we see? A pretty significant move here. So we finished today at 73.86, but our low today came in at, I'm just going to highlight it here, 72.37. So we had about a 150 plus point swing. And in fact, we had a bigger swing than that because we were up in the morning. Look at our high today. High today was 74.83. We finished at 73.86, about 100 points off of that high, but still also a pretty healthy 150 off of the low. So we had a massive range day today. Now, that said, what's intriguing to a lot of the bulls is the hammer candle here. Now, granted, did we flip it to green? No, we did not. But nonetheless, it is a fairly important development to see bulls were unwilling to let it pierce through that 72.40 for longer than a moment or two. We've got the upswinging 50-day moving average just beneath us at 71.95 approximately today. Could act as short run support. One thing we know, we are apt to see that 50-day moving average a little bit higher at the open tomorrow as we take off the prior 50th day in the past and add tomorrow's opening trade and tomorrow's action to it. So chances are we're going to see a slightly higher 50-day moving average. It is notable, Rita. Yeah, we hit the 20-day, didn't we? Right on the nose, intra-period, and then got that reversal today. So clearly, there was some bearishness after we had rallied into the 20-day. We needed more of the selling that we got this morning to take us down to a level where bulls felt comfortable really deploying new money. And that's kind of the takeaway today. I'm going to skip on through to a 15, or pardon me, let's go to the 1 hour. This is the 4-hour bar, as it were. This chart here covers the last 180 days. Let's just zoom into the last 90 days or so. And this 100 period, in this case, 100 period or 104-hour blocks, looks like we tagged that with today's low. We might have a pretty healthy area for short-term traders to balance their risk. And, again, as we always do here, we don't know where support necessarily resides, but we do know where we could choose to move on from our trade if it's not working for us. And the give back we've seen here is not substantial. It's on the level of what many traders would say is a standardized pullback. As I draw this line in, what we're going to find is our peak to trough pullback 4.75%, less than 5%. So basically a very standard pullback to the intraday low today. Also, notice it happened to be a gap level for us back here on May 6th. So from May 5 into May 6, we gapped higher, more or less held that gap. Now, if nothing else, everybody, you might have a level against which to base any new movement out of the S&Ps on. If we broke this level, maybe we need to find horizontal support, and that might reside somewhere back here in the ballpark of 7,000. Remember, 7,000 was a pretty important level for us originally, and while there are going to be likely some areas we might see some hold up in advance of 7,000, don't forget to think about those very round figures today, all right? So just to give you some ideas as to where we might end up finding support, you've got a few different layers. And of course, as far as trade management is concerned, the reminder to all of us is that we all manage our trades a little bit differently. Some of us are all in and all out traders, and others of us like the idea of piecing out of those trades based on short-term weakness. So, if you traded under the first white line here at 72.58 with any conviction tomorrow, some traders would lighten up, and the expectation might be to see a lower test. And then if we took out 7,050, they might move out of some more, or they might just sit on it till they get to 7,000, thinking that this could be support. So as always, it's going to be different for each of us individually. It's our job to just make sure we're managing the trades we're in effectively to our own comfort. That's really the hardest part about all of this, of course, is doing it to our own comfort. So S&P, very, very interesting day. We're going to see how tomorrow looks, obviously, but that's going to dictate, probably to an extent, how the rest of the week looks. So, do we continue the way we got that strong finish today? If we go back to something real briefly like a 1 hour chart, yeah, look at, we moved pretty effectively off the lows, right? Nice 2% pop, but doesn't do much for us if we can't get through that layer that we failed at, which was, as Rita pointed out, the 20-day moving average up here around 74.80, something we need to get through short run. So that we have these various areas. Let's just see if we can push through and give us new ways to manage our risk. Now, today we also saw the NASDAQ with a pretty healthy bleed down. We finished down 1%. Also got the similar tail, right? We fell through horizontal support with pretty good conviction. If we're looking at my Fibonacci draw tool, we've got the 38% Fibonacci line lining up with the 50-day moving average. Some traders will make note of that. Doesn't mean we have to get there, but it sure would be notable if we got there and held up. And that is to say the selling ran its course at that spot. So maybe eyeballing that, but on the intra-period chart, it's going to look very similar, everybody. Here, we can even extend my line here. Just go forward a couple of days. and get it all the way. Well, actually, got to go through the today, I guess, take it through the 9th, 10th, 11th. There we go. Now we got it through the week. So, hey, this is a level that the NASDAQ wants to maybe test. We'll have to see if we get there. But if we can't get through there, well, then it's going to be really hard for us, obviously, to think that we've got a continuation of our uptrend that we've been working with dating back to early April. So the bigger move today actually occurred with the Russell 2000, which actually had an incredible swing day and finished positive today. So we are back on the 20-day. So the 20-day here comes in at 28.65, and we finished at 28.67. So we violated it by a pretty healthy amount, got all the way down under 2,800 today in the Russell 2000, and then managed to finish on or above the 20-day. So this actually still looks like maybe the healthiest of the major indices here, simply because we held the 20-day. We'll see if that trend holds, but it almost looks like we tested horizontal support. And you know what? Tomorrow or the next day, maybe by the end of the week, we're going to see that 50-day moving average caught up with the line we tested today. Potentially, that could give us some confluence and structure at the 50-day for a support level moving forward. The big reason I think you saw Russell doing better today, we had the 10-year yield pull back. The 10-year yield has managed to fill in that little gap. We've been talking about what looked like a bit of an island up here in yields on the 10-year, and we've rallied into it, but we haven't gotten above it. So the fact is, maybe traders are still feeling kind of positive about it. I got to be honest, though, everybody, this looks like a bullish trend for yield. And that might imply for many of us that we expect yields to continue to climb, which is to say we might expect bonds to continue to be sold. That stands out on this chart to me. Now, it was down today, and if we can push this under 4.5 again, that'll be the level where we really see more of a push for and in the benefit of small caps. But any movement that makes a new short-term high, if we get through 4.5 tomorrow and trade above the highs we've made over the last 3 days, I think that many traders would look at that and say, yeah, we've got risk relative to small caps. So we need to see some buying of treasuries in the 10-year yield, at least, that would push yields lower and maybe buoy the small caps. All right, so there's a brief look at our closing market here. We're going to spend another 15 minutes or so here taking a look at our example portfolio. Like I said, we had a number of trades go off for us this last week, most of which were selling on weakness, but we did have an HPE trade that we wanted to look at. And HPE, we exited twice over the last week. We did so for a portion of it up here at 55.38, and then we raised our stop, and then after having raised our stop, we got stopped out on our remainder. So we did great on this one, everybody. 24.55 up to, for 100 shares, we were able to unload for more than 100%. And then for the second 100, because we utilized our stop, we raised it and we took advantage of our weakness, we got taken out with another 100%er. So we really don't have a whole lot of reason for anger with the way this went, especially now since we've seen the stock go lower. This one worked out beautifully. I wish I could tell you that they're all going to work out this beautifully, but I want to remind you that our process is what led us here. One, we had a process to sell a portion that we got up into an area we would be a happy seller at. We got that. We took that portion off. We raised our stop order in there to make sure that we could get taken out of the second 100, and we did. But I'll point out our sale of 100 at 49.94, I don't think that was our trade. I think our trade was a higher stop than that. So I think let's see here. There's the first 100, here's the second. Well, it's tough. I can't go back and see the actual order, I don't think, any longer, but ultimately it did not execute near our trigger because of a move, a good move lower. So we got executed, but not near the trigger we were hoping for. But nonetheless, did just fine on that trade. So, a good review of our process working out for us. Let's check out VRSN. We had a small 35 share position here. And on this one, it's going to take a second, it looks like. So we were working with a 20-day moving average. My trade should be noted here. Let's see here. Yep, it says show trades. I think it's going to take just a moment before it highlights them for us. But so we were in VeriSign, and here's what we'll do. We'll just go up to our symbol here and change this from 7 days to 30. I don't think we were in it much longer than that. All right, we'll go to a few more days just to see. All right, so we got in here at 273.05, and then we got stopped out about 9 points up, or 11 points up, excuse me. All right, so again, same thing. We were working with our 20-period exponential moving average. We added the average true range, or rather reduced our exit strategy by the amount of the ATR, and that led us to get out where we did. We got stopped out a few days back, as you can see. Now that it's tested the 50-day, some traders would be looking at this and saying, well, this could be an entry. It won't make the list for us today because we are not above all three major moving averages. Remember, in our process here in this class, we are trading the leaders, and we're finding uptrending stocks that are uptrending in all three of the major time frames, the 20-day, the 50-day, and the 200-day. Those are the three we're using here. That does not mean you could not build a trade like this one against the 50-day, simply pointing out that we have had an excellent move to the upside, have retreated to an area that many traders would call support. In fact, let's just see if we can validate the 50 with a little Fibonacci move. We'll throw this up there. And so we're in the middle of a Fibonacci sequence here, right? Some traders would say that I would prefer not to place this just based on the fact that we're between the two Fibonacci sequences. Some of you would say, yeah, if we get back above the 23% retracement, that's when they would initiate a trade. But the nice thing about thinking about entry here is that you are relatively close to the 50-day. And so if a trader were to use the 50-day at about 281, less the amount of the ATR of almost $9, it puts you down in the ballpark of 272 for an exit strategy. So just to give you an idea, it can work. It's just not going to make our list for today. Okay, let us take a peek at the other trades we've got working in here. Okay, we'll go back to my quick list. Eliminate VRSN. And we've got, we got to look at, let's look at NVIDIA here. This one definitely didn't quite fall the way we'd hoped. So we got into NVIDIA on a 20-day support test, and then we got a rally out of it, and we pushed our stop order up a little bit. This is just one of those deals, everybody. Once again, picking the right moving average might be the most difficult aspect. In fact, if you're consistently doing this, a lot of traders, no matter their process, are going to lean into the same moving average every time just to give that consistency. Had we used the 50-day moving average instead, one, we would not have had as big a position. We would have had fewer shares because we would have had more risk on a per share basis. Number two, though, we run that risk of being stopped out probably today. So today's 50-day moving average was 205.01, and our ATR is about 850, and that would give us, somewhere in the neighborhood of 196.50. So we actually would have stuck with it today based on the low at 199 and change. So, if you were working with the 50-day, yeah, this could have worked. But about a week ago, we had every reason to think that the 20-day could easily be support for us, and that was the reason we got into the trade in the first place. So that's the reason we built it the way that we did. So just a reminder about that particular process here. Okay. Let me see. Give me just a second here, everybody. Got a little bit of a lag, and I want to try to eliminate it as best I can. So I'm going to close down some other details that I've got open here in the hopes of maybe speeding up that lag a little bit. All right, let's go back here. Let's look at our CleanSpark, and then we'll check on Morgan Stanley. So CLSK. Yeah, so this one, similar situation. Big moves to the downside. Obviously, we have a significant pullback. Not a shock that we got stopped out here. In this case, we got stopped out on Friday with that huge candle and tail. It's going to happen. Let's look at Morgan Stanley. We actually have shares still in Morgan Stanley here. We did a limit sale on a portion of it up in the ballpark of 220. Let's see how that worked for us. All right, so we sold 10 at 215.03, and we have a remaining stop in here. Let's go to this. Aha! We do not have a remaining stop because our limit was targeted with our, or rather bracketed, excuse me, with our exit. So we need to make sure we reestablish our Morgan Stanley stop order here to protect the profits that we've got remaining. So let's do that here. Let's go into Morgan Stanley and let's take our close, our 202.92, which is the 20-day moving average at the close. And then we're going to reduce it by the amount of our ATR, $5.82. We're going to round that up to $5.83. And that says 197.09. So we're going to have a stop order there. So I'm just going to go back to my trade or my monitor page, right click, create closing order with stop, and change to good till canceled. And 197.09. Now, many of you who are here frequently, you know I like to push those down even further, especially if we're just barely above a round dollar figure. I want to go a little lower. And the main reason is I just want to work to maintain the long position as long as is possible. So we're just trying to keep the position, and the longer or the wider our wiggle room we provide, the better off we are, maybe the more likely we are to stick with our trade. Now in this instance, if we got stopped out at the price we have designated for our trigger, we'd still be profitable in the trade, which is one of our key details here. But nonetheless, we want to make sure that Sorry, everybody. Thank you for your patience as we work through the technical details. We were just answering the time frame question here for you relative to when we got this account building. We started it January 1st, basically, or immediately the first week of the year. And so we've had a number of key trades. So for those of you who want to go back in time and see how the rest of those trades have been, what you're going to find is our original process, maybe not as well defined as it is today. But you can definitely go back and find some trades that have worked for us, and then you're going to find some that, like we're reviewing today, that haven't been ideal, right? We're going to make some great trades, and we're going to make some poor ones from time to time. That's just the nature of the process, of course. So, all right, before we wrap things up with our review, we do need to look at Dollar Tree, because we just placed a new Dollar Tree position last week. So we started a trade with new 75 shares in DLTR, and I don't think there's any reason for us to make any adjustments here. You'll see that we are in at 109.96. Interestingly, the stock has not only held the 200-day with today's close, but you can see that we are holding this gap level, and we put our stop down an ATR below the gap level here, below the lowest low. That was what we used to define our stop exit. So that's where we are right here on the 20-day. Now, if we can get this to break higher, we're going to be able to move this one up potentially next week. But if this just continues to languish, well, it can stay here. But the good news is, even if it goes sideways, that 20-day is going to be caught up, hopefully moving through the 50-day here, which will give us a higher 20-day moving average, and thus maybe a chance to tighten our stop a little bit if we wanted to reduce our risk next week. In an ideal world, what we get is a break higher through 117, and the stock starts challenging our upside target, which is currently up there at 135. Obviously, that'd be a wonderful development, but a little behind, a little wait and see on that, obviously. Okay. So there is our existing position from last week. Let's go back into this one, and we will look at, we've already looked at MS, so last thing we need to do is look at EW, and then we're going to go talk about new example trades. So EW, we've been in since this gap move up, and what it's been doing is consolidating here. So holding up. Interesting that it's gone sideways for 2 full weeks, and the 20-day is catching up in here now. Notice the low yesterday, the low Friday, right on the 20 essentially. So maybe, you traders out there look at the 20 and say, all right, maybe I need to tighten this up a little bit. I don't know that we need to. I feel pretty decent about where we are right now, but if we were to tighten this one, we would take 84.77 less $2.51, and that puts us at 82.26. And yeah, we're in at 83.03, so no, we're not going to go lower. We're going to stick with where we are. I think we built this one based on the lows from the gap, or basically the low of the day we bought it, is how we came to this 83 and change. So for now, more of the same. We'll stay the course on EW. Now, let us revisit our process and then talk about the new potential example trades for consideration. So remember, we have an account size that we built from 100,000, and we're just defaulting to not taking a position bigger than 10. We can do anything under 10, but 10 is our max position size, our full position. We are not going to risk more than 1,000 on any one trade. And we are going to place stop orders for exit strategies, 1 ATR or a little bit more, 1 ATR below our preferred simple moving average. Ideally, we're trading the leaders. We're looking for stocks in uptrends already, in uptrending sectors and industry groups. And so today, what that means is we're going to look at technology. I thought, hey, technology's taking a beating, right? And there are going to be some pullbacks that make the list here in technology. And if we're looking for technology exposure, then perhaps you could be looking in some of those groups. So one of those very popular groups, obviously, is memory of late. Let's talk just quickly about that, because today's action in Micron and SanDisk were kind of notable. Micron found the 20-day moving average with its bottom today, and that got bought up. Unfortunately, the math just doesn't really work great on Micron in an account like this. I mean, we're talking about maybe a 10-share position that we could take, right? But then we got to use the 20-day moving average, which seems to have confirmed as support. But we go use the 20-day minus the ATR, and now suddenly we're giving up 150 points a share. And that just doesn't feel good, even if it's a small position. The same can be said about SanDisk, which also made this list today, tested and held its 20-day moving average, but the same thing, everybody. If we want to use 1562, but we're buyers 100 points up, and then we got to use 1562 less the ATR, which is 135 points, well, that pushes us down into the neighborhood of 1430 for a stop order, and now we're risking 200 plus points. That's just not tenable relative to our portfolio. I see your question. Yeah, Western Digital can make the list here a little bit better in this regard. If we wanted to use the 20-day on this position, we could. 512.59 less 33.5. That could be workable, so to speak. Puts us down into the neighborhood of 480. but we are still risking about 40 bucks a share. Now, at least that one's feasible relative to what we've seen. But I found a better one in the same space. And the reason is because it looks like it's dabbling with a breakout. And I mean dabbling because this is the highest close that Amphenol has seen all the way dating back to when it did break to new all-time highs there back in January. And so this one looks more consolidative in nature, doesn't it? And potentially like it's ready to break out. We're going to call that 120, and then we could snap this up here at 156, and then that gives us about a 26 point level, right? A range for consideration. And so I thought maybe what we should do is talk about a buy a stop on a breakout. So if we use 156 as our line, we want to trade through 156 and say, let's go with, well, let's see, what's 1% of 156 would be $1.56. So that'll give us 157.50, let's say, as a buy stop area. And I got that, again, just a 1% move through a level that we as traders might deem to be resistance. So if I said 156, I could go 156 times 1.01 as a reflection of 1%. And then I could be a buyer at 157.50 and above. So I think that makes sense, everybody, because, this is, again, I know not everybody is a big fan of buying on breakouts, but buying a breakout from a range where we are at essentially highs, if we can move this to a new range, well, then we might expect the opportunity to be the height of the range we break. So it might look kind of like this. So let's consider the opportunity to take this one all the way up to maybe 190 or so. And that would be great for us. Obviously, we do need to manage our risk along the way, but this could still be a pretty great trade if it does break out and starts to run. Okay, so we're going to do a buy stop at 157.50, but what we are also going to do is incorporate an exit versus today's low to do that. So today's low, because today looks like we're breaking out of this little tiny consolidation, right? It looks like a bit of a bull flag that we've just broken from here. So we're going to take that low, because the truth is, if we were under that low, we probably don't want to stick with this trade for too long of a window, okay? So now, again, we're going to be giving up maybe too much for some of us. So some of you would say, well, 157.50 on a buy stop, I just want to risk a static amount. And so in this instance, why don't we start with a variation of our potential profit situation here. So if we put ourselves in the trade and we get the move we are hoping for, we could see 25 points of upside. So let's just use 1/3 of that, and we'll put an exit right beneath that. So we'll go 8 points of risk from our entrance. Okay, so 157.50 on a buy stop minus 8 will give us 149.50, and we're going to go, of course, beneath 50 cents for our stop there. So reminder that the math needs to be proper. So if we're in, and again, we can't guarantee that we will buy at 157.50, but we are going to be basing our risk tolerance on $8 a share. And so I'm going to take 1,000 and divide that by 8. Tells me I could own 125 shares, but I can't own 125 shares because that's far too big for position size relative to what we're striving for. So we're going to drop that down to 50 shares. 50 shares at 157.50 would be just shy of 7,900 for a position size. So that fits in all of our calculation details. So that's how we'll do it. We will right click to buy custom, and we will do this with an OCO bracket. So here's the way that I have found to be protective and also be able to sell for our limit. It's going to ask us, basically we're going to do two separate identical purchases, and one of them is going to be bracketed and stopped, bracket with a target up above, and then the other one's just going to be a stop. So we're just going to do this twice for 25 shares to put us in our 50 share position. So first thing I'm going to do is I'm going to change this to 25 shares. Make sure this all lines up. Now we know our target up there is about 190. Okay. So tomorrow, first thing we got to do is a buy stop for tomorrow's business. We got to move through 157.50. Okay. Now I'm actually going to change that to good till canceled here, everybody. And the reason I'm doing that is that I don't know that this breakout comes tomorrow, but if it comes any day this week, I think it makes sense for us to give consideration to placing the example trade. So we're going to use a good till canceled buy stop at our 157.50. And then our limit will be good till canceled. And that's going to be at about, we're going to go with 190 for our target on those 25. And then our stop at 149.50 minus a few pennies. And we're going to go down to 149.44 and also good till canceled. Okay, so this one, for our 50 shares, we're doing 25. And again, the reason we're doing just 25 to start is I want to be sure that I've got that stop order in here after the fact. When a bracket goes off for a portion of it, it eliminates that next stop. And that forces me to be on the ball and come in and make sure I replace my stop. This is a step that is an extra one, but it's going to help me make sure that I don't need to come back into the tool. If I get my shares sold at profit, I'm not going to have to come in and add a stop on this after the fact. So there's my first 25. I'm going to go right click on that buy and I'm going to say create duplicate order. All right. And actually, we're just going to start from scratch here because it wants me to, it's going to create the duplicate, but it's not going to incorporate my bracket. So here we go. 25 is our buy, not 250. All right. 25 and not, whoops, sorry everybody. This one is a stop only, I apologize. So this one, stop only with no target, 149.44 for our stop good till canceled, and 157.50 for our good till canceled stop buy stop purchase. All right. Boy, it likes to make all those adjustments when I make one single mistake. It wants me to do them all again. So again, we're buying 25 as a buy stop, good till canceled. We trade through 157.50. We will buy, no guarantee of price on our purchase because we have a market order. And then if we get the shares, we've got a stop to protect us. But this 25 will not have a limit. So if the first 25 limit goes, we're still going to be in this position having another 25 shares and a stop will need to adjust. But if nothing else, this way at least, if we get that 25 shares sold, we are still protected on the others. And I think that's a big deal. I came across this a number of times this weekend, actually, in San Diego, talking to clients who have had this play out for them. And I wanted to make sure we created a way that that we could manage it without getting stuck, without having our limit go and then and thinking we're protected and then not being protected. That's the worst of all situations. So we don't want that. Okay, and then the other group that I was looking at was healthcare, and that's mainly because healthcare once more has been showing some signs of life in here. I think that's the staples. Let's see. Here we are. All right, there's our healthcare chart. So it's been improving. We're above all three major indices, major moving averages there. And we have gapped. So we've got a little bit of a gap this last 3 days. So Friday was a bit of a defensive day. We saw staples doing well. We saw healthcare doing well. And we created a gap in the healthcare sector. So this was another one that could be reviewed for potential example trade opportunities. Here's Solventum above the 20-day. You've got a little bit of a gap level here. And the 20-day seems to be pretty stout going back to mid-April on that one. Yeah, I know United Health has been showing some wicked strength of late. Let's see United Health. Yep, there you go. Bounced beautifully off that horizontal support. Remember, this was resistance for United Health back in the after having fallen so aggressively, and we got pushed back from that level in late October and got all the way back. So from 377 all the way back to 255, just an incredibly big move again before it found its footing. And then once it did find its footing, the key takeaway on this chart for everybody, breakout, former resistance can become support. And in this instance, not only did it become support, it coincided with the 20-day moving average. We were beneath it for 3, 4, 5 sessions, but we did not break down. And then we finally moved higher there. So a nice little development in United Health. You're absolutely right. Couple of these other ones I wanted just to talk about. Here's another AbbVie sitting on its 200-day moving average. The ELV actually made our list last week, and we just chose not to place the trade. I almost feel kind of silly about that now because it looks downright perfect at this point, doesn't it? Especially when we add more time to this. We clearly had a trade where we should have been a little more willing. I should have been a little more willing last week to establish something, because this looks like nothing more than consolidation at prior highs. And if we consolidate and hold at prior highs, then we have a good opportunity to move higher. Here's a look at this one on the weekly as it encroaches its 200-week simple moving average right above us. Keeping a close eye on those levels above. Kind of notable though. Big very tall candles here up at about 460 if it can push through the moving average. I thought that was kind of interesting as well. And then let me see, was there one more? Oh, we got to talk about Lilly. Lilly's been crazy too. Lilly broke to new all-time highs, tried an immediate breakout, couldn't do it. What happened? It had to come back to the 20-day, and then from the 20-day slingshot move higher from about, 1050 all the way up to 1178. So a real quick, speedy 10% pop there on Lilly, and it's trading at new highs, having moved out of this range as well. So as always, be thoughtful of price action, be thoughtful of price levels that get broken to the upside and then hold. Really interesting developments. And I know the hardest part of that is watching and listening to all the narrative conversation and then overlaying your familiarity with charts in the process. It gets to be very difficult from time to time. I recognize that. But try to lean into price where you have the opportunity. It can be quite helpful. All right, we will wrap it up there, everybody. But before we kick it off for the day, I just want to remind you that we've got that option strategies workshop this afternoon. This is day 2 of that event with our friends Scott Durfee and Ray Kimbrell. They're going to take you through this the remainder of the week. So you've got today session 2, tomorrow 3, Thursday 4, and on Friday a Q&A day where you have an opportunity to, having gone to these classes, and you have an opportunity to really get your specific question answered. So we ask you, of course, to go ahead and register for the event. It's wide open for you. Scott and Ray are fantastic at the education process. Not only are they fantastic at it, but they've been doing it together for 20 years. So you're going to get some consistency out of these guys, and I really think it's a great way to continue the learning process if that option stuff is something you're looking for. So please put this one on the calendar this afternoon if you've got the time. All right, with that, we'll wrap it up. Thanks to James Boyd there in the chat. Again, make sure you're following us on X, James Boyd CS, Kevin Horner CS. If this was helpful for you, please hit that thumbs up button for me down below. We get this one reviewed and into the archive. Chances are it'll be there for you early tomorrow morning at the top of the list. Hopefully, we've got at least that one new trade to check out next week. So with that, have a great rest of your Tuesday. I look forward to catching up with you all again real soon.